Hi ladies and gents, what we're going to look at today on this podcast, we're going to look at the sales ledger control account. It's also often called the total trade receivables control account, or possibly the trade receivables control account, depending upon which specification you're doing. Basic reason for this is what we are actually doing is a way of checking that we've made all the correct entries from all the daybooks into the sales ledger. So what you're already familiar with is, for example, here we've got a customer called James, and James bought £300 worth or $300 worth of goods, and he bought them on the 3rd of May. So what we've done now, we've got a debit entry in James's account of $300, and that debit entry has been made because James is now an asset and owes us some money. You can also see here that James has returned some goods to us, so because he's returned some goods to us, that's going to reduce the amount of money that James owes us. So what that will be is a credit entry in James's account, because obviously it will be a debit entry in the sales returns account. Similarly, James has actually paid us some money and he received a discount, and we know this discount is a cash discount because it's recorded in the cash book. And what you also see here is a cash book. I've only put the debit columns in, mainly so that you can see the whole picture about what's going on. But he's received this discount of $25 and he's paid us $275. So that's on the credit side of James's account, because again, both those entries in theory are reducing the amount of money that James owes to us as an asset. What you will notice there though, I've deliberately missed out one of these entries, and that's because I'm going to show you how the sales ledger control account tells us that there's been an error somewhere in the accounting records. So how do we do the sales ledger control account? Well, it comes straight from the daybooks. So we don't use the individual entries, we use the totals that are done at the end of the month. And the first thing we're going to need to know is what the opening balances are. In this case, we've got 3 customers, and they owe us a total of $1,050. So what you can see is that the balance brought forward is $1,050. It's an asset because it's replicating what happens in the customer's accounts. And the opening balances in the customer accounts are on the debit side because it's money owed to us. We're then going to increase the amount of the asset. So what we need to do is we need to put the total of the sales daybook in. And we've then got the sales returns. Total of that was 70. Okay, so that's going to go in. What you need to notice now is the first entry was done at the start of the month. All the other entries, because their totals, are done at the end of the month. And normally in an exam you'll get a mark for getting the date part right. So it's an important thing to make sure you do. Okay, then got the cash payments. They total $910. So I can put those in. Sorry, got the discount allowed first. And then we've got the cash payments. Okay, fantastic. Now what we need to do is total them up. Well, the bigger side is clearly going to be the debit side, and that's what we'd expect normally on one of these questions. So what we now need to do is make the credit side the same side as the debit side by putting in a balance carried forward. Okay, and then on the debit side, we're going to put in a balance brought forward. And what I can see now is when I look at the totals of all the customers' closing balances, that tells me that I made $1,205. But my sales ledger control account tells me I made $1,150. Sorry, $1,180. So I can now go and look around and try and find the error. Well, I've already told you what the error is, so there's no problem there. We know it's James's account, so hasn't been done correctly. So if I go and put in the $25 discount, and that was given on the 13th of the 5th, 2015, and it's a discount allowed. And what I should find now, and I do, is this total, the total of all the closing balances, is the same as the total on the sales ledger or trade receivables control account. Right, how's this going to look in your exam? Well, it's probably going to look something like this. Okay, so what we need to do is to work through, and we need to see how I've come here. So opening balances. First thing is, there's two opening balances here. Okay, there may or may not be our exam question. The reason why it's possible to have a credit balance is if you've actually paid, or somebody's paid you and then they've returned some goods, or they've made an overpayment, or possibly they've just made an error and paid you too much money. So it's quite possible to have some of your customers actually being owed money and therefore a liability. But the bigger number will always be on the debit side in a sales ledger control account. Credit sales, they're going to go in and they're going to increase the amount of money that we're owed, so they go on the debit side. The one that's a bit of a strange one here, I've deliberately put it in the exams it's called a distractor. Cash sales are nothing to do with the sales ledger control account. Okay, next after that is the receipts. So again, at the end of the month, I need to put my receipts in. They're going to reduce the amount of money that I'm owed and therefore decrease an asset and therefore a credit. I'm going to need to put in my sales returns and discounts allowed. They're both going to go on the credit side because in both cases, it's reducing the amount of money that I'm owed. A refund is where we receive some money and for some reason we've had to pay that money back. So it's the opposite of a receipt and therefore it goes in the debit side. Because although some customers might have been owed money and therefore we gave them some money back, okay, what it has done is reduce the total amount that we are owed. So we need to sort of counteract the two. Okay, we've got a dishonoured check. If somebody doesn't pay us because they haven't got the money in the bank, clearly what we're not going to do is to write that debt off. So what we need to do is be included in our receipts, but we need to put it back in again because we're really still owed the 150. Contra, it's a little bit of a funny one. You've come across these already when you've done cash books, so it shouldn't be a massive problem. But a contra in this case is where we've got a customer who's also a supplier, and what we're doing, instead of us paying a check to him and him paying a check to us, we're going to write off some of that debt and he'll write off some of the debt in the purchase ledger control account. So again, it's where there's two entries in the same ledger, in different accounts but in the same ledger, in the purchase ledger control account, the sales ledger control account. And then finally, we've got this credit balance again in the, and it says on there that credit balance is a credit. What it means is that there's going to be a credit brought forward. So that closing balance needs to go on the debit side. I'm going to put that in there. Okay, and then the bigger side, hopefully, is going to be the debit side. So I'm going to need to make the credit side the same size as 17,500. And when I do that, what I'm going to find is that the balance carried forward is going to be 9,550. So therefore, the balance brought forward at the start of the following month, which is going to be on the 1st of August 2016, is going to be 9,550. I'll just put the date in there, and that's fine. The other entries are quite common to see in here. If there's a bad debt written off, because we're not owed the money anymore, we've lost it, it's become an expense, that would go on the credit side. Quite a common exam question is where does the something called the provisions for bad debts go? Well, some of you won't have covered it yet, but the provision for bad debts won't go into a sales ledger control account because it's where we're trying to estimate how much we're going to lose in the future. And it isn't something yet that's happened in the actual customer's accounts. So if we just ignore it completely, because although we know there's probably going to be some bad debts amongst all of our customers, we don't know which one, so we wouldn't enter a provision or an estimate for the bad debts in an individual's customer account. And we're checking the sales ledger, we're not working on profit or loss. Right, obviously, a couple of questions for you to have a go at. They get gradually more difficult. Good luck with it, and I'll see those of you I teach very soon. Bye-bye.